Hello, Matthew Bell with Alzheimer'sProof.com. Some people choose to transfer a portion of their long-term care risk to insurance companies. Now, I actually have videos where I talk about how that can be done with a life insurance policy, but the more straightforward way to accomplish that is with a dedicated long-term care insurance policy. But these can be extremely confusing, so in this video, I hope to try to shed some light on the bewildering assortment of options that are available. Now, many times people become open to a long-term care insurance policy through personal experience. Now, this could be a positive experience where maybe they saw a relative who had to get long-term care and whose experience was made just a little bit better than it might have been otherwise because they had access to those funds. And sometimes, like in the case of my mom, it is a negative experience. That is, the family doesn't have a long-term care insurance policy, and you can see the devastating impact that it has not only on the family, but also on the family's finances. Now, I've seen basically three common reasons why people might be open to having a long-term care insurance policy, and I state these in no particular order. Reason number one is that they do not want to be a burden on family members. Or to put it more positively, they want to make provisions for their care that don't depend upon sons, daughters, spouses, and so on. Reason number two is that somebody is afraid of and does not want to end up in a nursing home. Or once again, to put a positive spin on it, they want to have more control over where they're going to have their long-term care delivered to them, for example, in their own home. And number three, they don't want their assets to be devastated. They don't want to have to spend their money down, or they don't want to have to spend their money on their care. So here, obviously, if you're paying for a long-term care insurance policy, you're spending some money toward your care. But the idea here is that the long-term care costs can be so large that they can really wipe out retirement nest eggs, and they can do so fairly quickly. My dad was in a nursing home of no particular luster to it. I mean, it was a very basic nursing home, the cheapest one we could find in almost every sense of the word. And it was still $300,000 over the course of 4 years. So you're talking $75,000 a year, even for a bare bones facility for long-term care services. Now, there are two overarching policy types, and we'll call them qualified long-term care plans and non-qualified long-term care plans. And here, qualified refers to tax qualified at the level of the federal income tax. So the IRS, in other words, the Internal Revenue Service, has a definition for what constitutes a qualified long-term care plan. This is intricate enough and specialized enough that I've actually covered it in a dedicated video, so I don't want to spend time here. Where it's appropriate, I may make a further mention of this because it does crop into the discussion we're going to have. But if you just want a concerted, focused conversation on the differences between qualified and non-qualified plans, I'll direct you to my other video. Once the tax status has been established, the main differentiator between policies is going to be the question of what care environment or environments they apply to. There are really two main subtypes of plan. The first is nursing home only, and obviously, just like the name sounds, that plan only applies if you are in a skilled nursing facility. The second type of plan is called a non-facility only plan, or sometimes it's referred to as a comprehensive plan, and I'm sure there are many other names for it. But what this plan does basically is covers you in a wider variety of care environments. So for example, it might cover adult daycare, assisted living facilities, might cover home care, certainly it would cover nursing home care, and it may even cover sort of specialty scenarios like if a person needs hospice care for end-of-life services or respite care where the primary caretaker, being, let's say, a family member, could avail him or herself of a care facility in a very limited sense in order to just take a break. That's respite care. Now, I have a dedicated video on different care environments where I describe these in further detail. So one question you definitely want to ask if you are considering a long-term care insurance policy is, what environments does it cover? Notice when I said there are three reasons that people often are interested in long-term care policies, and one was a fear of having to end up in a nursing home. Obviously, a person like that would not want a policy that is nursing home only. So if your ambition is to try to avoid a nursing home, and you want to try to do so in part by having a long-term care insurance policy as part of your portfolio, then you want to make sure that that policy covers home care, adult daycare, or any other type of service that might help you in the long run to avoid having to be in a nursing home. Beyond care environment, obviously one of the main questions for any long-term care policy is going to be, how much does it pay and over what period of time? In order to get into these questions, we're going to have to unpack a little bit of math. What I want to do in this video is to try and do it with as little math as possible. And in a second video, I'm going to get more in depth for those people who are actually interested in going a little bit further into the math, but I'll just try and give you a higher level view in this video. So let me tackle first the question of the period of time over which the policy applies. In the past, it was not uncommon to find policies that were essentially indefinite. They might be billed as lifetime policies. In this case, of course, you realize that a person with a diagnosis of Alzheimer's or dementia has a disease that is incurable. There's no cure for Alzheimer's at present. So in a sense, a diagnosis of Alzheimer's disease will lead inevitably to a person's death, in that the person with Alzheimer's is essentially going to die with the Alzheimer's. Now, they might die from the Alzheimer's or simply with the Alzheimer's, but in any case, it's a terminal illness in that sense. It's got to be with them for the rest of their life. I have a video on how a person dies with Alzheimer's disease, and I cover some of the differences between the usages of the term terminal illness, so I'll defer to that conversation. But basically what a lifetime coverage amount essentially meant in the language of long-term care insurance policies was that there was no predetermined endpoint to the amount of time that that policy would pay out. So it wasn't like you had a 10-year policy or a 5-year policy. It could go on and on. Now, these days, those policies have essentially gone the way of the dinosaur. They're fewer and further between. The primary reason for this has been financial pressures on the various insurance companies, and you will find that the number of companies offering any long-term care policies at all has dwindled rather remarkably and rather dramatically over the past decade or so. But an insurance company will say to you, well, look, if lifetime coverage basically had an open-ended risk profile, in other words, there was no limit to the insurance company's liability. They could, for all they knew, have to pay out for 20 years. And anybody who has had a loved one in a nursing home always knows at least one story of a person who's been in that nursing home for just some large amount of time, 20 years or something like this. So those are usually exceptional cases. Most of the time, people go into a nursing home and they spend a limited amount of time there. The insurance company would say to you, well, look, having open-ended policies with no limit to our liability threatens to undermine the financial security of the insurance company. The stability of the company is threatened by those types of policies because we could be on the hook for just an open-ended amount of money. And so it benefits everybody to have limits on there because that shores up and buttresses the financial stability of the company. But from the standpoint of the consumer, one of the things to bear in mind is the average amount of time a person spends in a nursing home. And when I Googled that, and you can see for yourself by doing the similar search, what is the average amount of time a person spends in a nursing home, you'll find that it's around 835 days, which, if you do the math in terms of years, is about 2.2, 2.3 years. Now, that means that the average amount of time that you can expect to spend in a nursing home is less than 3 years. And in fact, further research, and I'll give you this in another video where I concentrate on some of the statistics, which are in and of themselves a bit difficult to get a grasp on. Many people go into a nursing home and die within the first year. So 1 year, 2 years, 3 years, for many people, their nursing home experience will essentially be limited to that amount of time. So it's arguable, in other words, that lifetime policies with open-ended limits are a bit overkill. It's far more common these days to find a policy that'll cover you for 1 year or 3 years or 5 years or 10 years or some predetermined interval. The question of which one to select, that's going to be one that's going to depend upon the amount of money you have to spend on premium, number one, and also on your estimates of how long you're going to spend in a nursing home. And I'll get into some of these figures in a future video. Now, I should say, when we tackle the question of how much the policy will pay, that there are two kinds of policy. One type of policy is called a reimbursement policy. And in this case, the policy pays you the amount of money you pay to a nursing home up to predetermined limits. So if you have a $150 a day benefit and the assisted care facility costs $150 a day, you pay the $150 to the care facility and the policy will pay you back the $150. There's also indemnity policies, and indemnity policies simply give you a block of money that you can spend on your care, irrespective of the actual cost of care. So if you had an indemnity policy that was set at $150 a day, then you would simply receive $150 a day. And if you were receiving care in a facility that only cost $140, you yourself could bank the additional $10. Most policies are going to be reimbursement, but there are indemnity policies around. Now, long-term care policies also have to be triggered. This is not dissimilar to any other type of insurance policy. For example, your property and casualty policy on your home, your homeowner's policy, if you have a fire, then the fire is the triggering event. If you have a hailstorm, the hailstorm is the triggering event. In a life insurance policy scenario, death is the triggering event for the policy proceeds to pay out. In a long-term care policy, you figure, well, when is the triggering event? And it's the event that happens that basically makes it the case that now you're in need of long-term care. So with a qualified long-term care policy, the predetermining triggers are well defined, and they are basically twofold. The first one is physical, lacking 2 out of 6 activities of daily living. Things like bathing yourself, dressing yourself, feeding yourself, transferring in and out of bed by yourself, toileting by yourself, being able to maintain bodily continence. That's number 6. That's controlling bowel and bladder function. Now, I have a whole video where I get into the activities of daily living, and you can consult that for further information. The second trigger is cognitive, so that would be having a severe enough cognitive impairment that you require constant supervision. Now, this is for qualified long-term care plans. For non-qualified long-term care plans, because they don't have tax advantages that they qualify for, their triggering events could conceivably be anything, but often they also include something called medical necessity. Medical necessity is a little bit vaguer, so on the negative side of things, it might be a little bit open to question as to what events actually qualify. But on the other hand, it can be a little bit looser as well. So sometimes you'll read descriptions of non-qualified plans that'll refer to them as more liberal in their trigger than qualified plans. But I would consult my video on the difference between qualified and non-qualified plans for further detail there. Now, when you're thinking about the payout amount, there are going to be a couple of numbers that are going to be very important to keep in mind. The first is the maximum benefit, the total lifetime maximum on the policy. This is the total amount of money that the policy could conceivably pay out if you exhausted it and got every last penny out of it that it was worth. So to think of an example, you've seen these water dispensers that are often in office break rooms or in waiting rooms or in mechanic garages. Think of that upper cylinder like the total maximum benefit. The upper cylinder contains all the water you can get out of there without changing the water bottle. So it's the total amount available. Now, usually you drink the water a Dixie cup at a time. And so if you drank it a Dixie cup at a time, you could tell how long that water bottle would last. So there's also the consideration of how much money you can take out of your long-term care policy at a given time. And this is where the daily maximum and the monthly maximums are going to come into play. Because unlike the water bottle situation where you could just continue to drink the water until you drank the water bottle completely empty in a single day, you can't do that with a long-term care plan. The long-term care plan is going to have predetermined amounts of money that can be taken out. If you go under those amounts, the policy might last a little longer in the case of a reimbursement plan. But if you meet those amounts, then the policy will last pretty much just as long as it was estimated to last. So in other words, a 3-year policy is estimated to last 3 years, provided you take out the maximum amount every time you have the ability to do so. Let me give you an example. Let's suppose you have a $100 a day maximum. Often the multiplier for a month is going to be 30. Some policies may use 31, some might use 30.4, 30.5. But let's suppose it's 30. So if your daily maximum is 30, your monthly maximum would be $100 times 30, which is $3,000. Now, if you have a 1-year policy, then you're simply going to multiply your monthly maximum of 3,000 times the number of months in a year, which is 12. So 12 times 3,000 means a 1-year policy on this benefit amount would give you a total maximum of $36,000. Now, if you have a 3-year policy, then you just multiply $36,000 on this example by 3, which would give you about $108,000. If you had a 5-year policy at the same benefit amount, it would give you $180,000 and so on. 10-year policy, $360,000. So in this way, the number of years the policy is supposed to be in force really acts as a multiplier on the benefit amount. And if perchance, with a reimbursement policy, if your cost of care was a little less than your maximum, your policy might last a little bit longer. Now, it's well to bear in mind the fact that the average cost of care in the United States right now is between $225 and $250 a day, which means that a $100 a day policy might suffice for some home care situations, possibly adult daycare and assisted living to a limited degree. But if you had to use a $100 a day policy for nursing home care, it's almost certain that you would have to pay more than half the amount yourself. And you want to bear that in mind as well when you're considering these policies. Of course, without the policy, you'd have to pay 100% of the care costs by yourself, so you can consider that as well. Now, just a couple of other things to consider. Number one is there's usually an elimination period with these policies. You can think of the elimination period like a time deductible. It's an amount of time you have to wait before you are eligible for benefits. So let's say that John or Jane Doe becomes benefit eligible on January the 1st. So on January the 1st, Jane, let's say, has 2 out of 6 activities of daily living lost, and John is cognitively impaired to the point where now he requires constant supervision. The question is, how much time do John and Jane have to wait respectively in order to get benefits paid out to them under their long-term care policy? And the answer to that is the elimination period. It could conceivably be anything from 0 all the way up to a year or whatever. In many cases, it's going to be some number of days. So it could be 30 days, 60 days, 90 days, 180 days, or whatever. Well, if Jane's policy is 30 days, that means that she has to wait 1 month before her care will start to be paid for in part by her long-term care policy. So she would expect to be able to receive benefits somewhere around the beginning of February. On the other hand, if John's policy has a 180-day elimination period, that means he's going to have to wait 6 months before his policy will start paying him benefits. So he's not going to get benefits until after June of the same year he is benefit eligible. There may be ways of mitigating the cost. For instance, maybe John can receive care from relatives for 6 months after he's benefit eligible, and then when he becomes benefit eligible, he could segue into a nursing home. But that would be for you to discuss with trusted advisors and with family and friends. Now, a second interesting thing to consider is whether or not a policy offers a discount when you and your spouse apply at the same time. This is not uncommon, and one of the reasons it occurs is because the insurance companies realize that your primary caretaker is probably living with you right now. If you are married, your spouse is going to be the one who starts to care for you first and picks up a lot of that care burden early on. And that means that there's a little bit less of a cost shuffled down the road to the long-term care policy. If a person is single and the only game in town is to depend upon the long-term care policy, then you're going to have to utilize its benefits more quickly than a person who is married and had some family support system. Now, there may also be ancillary benefits. Some policies provide for a certain amount of money to be spent on home modifications. Now, in some cases, that could be a separate pool of money, and in other cases, that pool of money comes off the total maximum. The primary thing I'm going to leave you with, though, is the idea that if you even think you might be interested in considering long-term care, the time to look at it is before you receive a diagnosis. A diagnosis of Alzheimer's disease, Huntington's disease, Parkinson's, some form of dementia, or some other cognitive or neurological dysfunction is almost certainly going to kill your insurability from the standpoint of a long-term care policy. The long-term care policy application process is also a little bit different than the life policy procedure, and I'll get into that as well in a different video. So you can always go through the application process and then opt not to continue. But my feeling on it is if you wait until you have a diagnosis, you may not be able to apply and get it at all. I can't give you personal advice. If you need personalized recommendations, you need to consult a licensed professional in your area. Certainly with anything to do with long-term care planning, you're going to want to consult a number of different people. I get into that further in some of the other installments in the series. But if you found something of use, I do ask that you like the video, subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. Don't forget to check out my written work online at alzheimersproof.com, and I look forward to seeing you again in another video. Thank you so much for being with me. Bye.